Hello, neighbors, and welcome back to the stream if you've been here before. I am Squealer D, and I am back again. And this time, my friends, we are back in finance. That's right, we are working on our stock market education. This is not the first. Whoa, we got two Squealer D's in the house today. I could hear myself. That's okay, guys. That's a good thing. Some days I start off and you can't hear me. Alrighty. So, as you see in the title today, we are going to learn what short selling is. That's right. Short selling is actually pretty interesting, and I am ready to learn it. All we have to do first is check out the news. So, it is Friday, and I said I wasn't going to be here Friday because I had something to do for my small child. But you know how plans change, so I figure might as well be in the money if we're not doing something else. Might as well be learning about the money, right? So I got my coffee, guys. I'm having a dilemma. Maybe you can help me. People are so helpful. They know more. Maybe you guys did something that I didn't do and you know something better about coffee. So here's my coffee for the day. D for dinero. You know that's right. We're learning about the dollar. So my dilemma, and if you watch this later, leave me a message. I like hot coffee. I like it real hot, like almost on the verge of hot, where you could sip it and it won't burn your tongue, but it's like, that was hot. That's how I like it. I like it to have steam coming off the top. But by the time I get here, like I make my coffee, and by the time I pour it and get it here, it's not hot. It feels cold, and I got to like heat it up in a pot or something. The whole coffee. I just dump it in a pot and heat it up. I think I need one of those cups, like an ember cup that heats from the bottom, and then they stay hot for 2 hours. I think I need one of those, but I need to know first if it's worth the money. Does it stay hot enough, or does it just make it lukewarm? Because I can't handle lukewarm. I would rather cold with ice than lukewarm. Lukewarm makes me feel like a bathing ape, like I'm drinking bathing ape water. I need it to be super hot or super iced. I have a super problem when it comes to coffee. That also means I have to drink it super fast, and I can't sit and like enjoy it. Coffee issues, guys. So what is new on Yahoo Finance? Papa Murphy's got a take and bake for $6.99. What else? Anything good? S&P's up, Dow's up, Nasdaq's up, Russell 2000's up. And remember, these are all markets. Remember, guys, to buy things. So, stocks reverse losses in week's final trading session. Hey, that's the guy. This is like the most famous trader guy. I can't say him now. Miles Udland, head of news. That's the kind of title somebody needs, head of news. Stocks on Friday were mixed as investors took to cap a topsy-turvy week with a rush of earnings from big tech giants like Microsoft, Alphabet, Meta Platforms, and Amazon holding investor attention. Through Thursday's close, the S&P 500 and Dow Jones Industrial Average were roughly flat for the week, while the Nasdaq surge on Thursday put the tech index higher by about 0.5% for the week. Stocks opened lower on Friday before reversing higher, but reports that First Public will likely become the fourth U.S. bank to fail since the beginning of March push markets back towards a flat line in the late morning trade. So we're on bank number 4, guys. Are they still saying it's not a recession? Is this a recession? I'm not typing. That's not what I wanted. Sometimes Google does its own thing. So, many economists agree that the U.S. is now, for now, not in a recession. The most recent gross domestic product report published last week showed the U.S. economy grew by 2.9% in the fourth quarter, following growth of 3.2% in the quarter before. What is a recession? Like, I know what a recession is, but what's the definition? What do they say is a definition? I don't believe these people. A recession, a significant, widespread, and prolonged downturn in economic activity. So, let's look in the dictionary. Oxford Languages says a period of temporary economic decline during which trade and industrial activity are reduced, generally identified by a fall in GDP in 2 successive quarters. So they're saying because it rose by 3% and 2%, we're not in a recession. But what else defines economic activity? Process that based on inputs leads to the manufacture of goods or the provision of a service. So, our gross dollar, our GDP could be higher because we sell gas now, though. I don't know. Seems to me like we're in a recession. But, you know what? I'm not the money man. My coffee's right at the verge right now. Got to finish it up. So, I can't believe they put billions into this bank and it still fell. Billions. $30 billion. That's crazy. It's crazy. What other good news they got? Exxon delivers a record first quarter profit on higher output. Of course they did. They can drop their oil wherever they want. ExxonMobil Corp on Friday reported a record first quarter profit that was more than double a year ago. That's because we drive more now. We're back at work, right, guys? Exxon, thanks, guys, making us go back to the office. So we use more gas because we're back commuting, guys. Some people are commuting for hours a day back to their jobs. So we're commuting and we're selling our oil now out of country to England, right? The UK, aren't we selling oil to the UK now? More? Because they don't get it? Germany? Do we sell more oil to other countries now? So last year, we imported about 8.32 million barrels per day. Imported. Exported more than they imported. So in 2022, we exported more than we imported. I wonder how it is for 2023. I'm sure it's double that. Top Canada and Mexico. Interesting. It's interesting how we export almost as much as we import. It's crazy. Why wouldn't we just keep it here and use it, our own oil, and them use their own oil and not ship oil back and forth through rickety ways so that we can have oil spills? Doesn't make sense to me. Doesn't make sense. I know it probably makes sense to somebody, guys, but it does not make sense to me. Why ship oil to Mexico if we're just going to get it back? Why? Why not just keep our oil? If we imported 9 or 8 and we exported 9, why not just export 1 and keep our 8? I don't get it. Is their oil better than ours? Is our oil better than theirs? Is it different standards of oil? I don't know who Charlie Gervais is. Oh, yeah, this is the girl. This is the girl that frauded J.P. Morgan. Man, this girl frauded J.P. Morgan. Charlie Javis, who sold her startup for $175 million, is accused of fraud. She went to J.P. Morgan and sold them fake information. Then they said it was fake and offered her a job, and she took the job. That's crazy. Oh, man, she had her money in SVB. So they seized her accounts. Of course they did. Javis bought a 2-bedroom, 2.5-bath condo in Miami Beach for $1.4 million. She financed the buy with $1 million mortgage with JP Chase. That's hilarious. This lady ripped them off for $175 million and then still got a $1 million mortgage. That's hilarious. So she got them. She got these dudes for $175 million and then said, "Could you also give me a mortgage, please?" And they did. That's hilarious. No wonder they're suing her. She took JP Morgan to the bank. That's crazy, guys. It's crazy. Okay. First Republic. $1.3 billion team quits First Republic. Well, I mean, of course they're going to quit First Republic. First Republic is failing. Why would you stay there if you got $1 billion? And they went to JP Morgan. I wonder what would happen if JP Morgan failed. We bailed them out before. How much did we bail out JP Morgan for? Oh, we got to put bailout. There's so much information. Okay, why did they get a bailout? Because how much was their bailout? $700 billion bailout? Dang. Well, how much was JP Morgan's? That was all of them. I want to know. $12 billion. You know what I don't understand? If we bailed these people out, right? $700 billion, we bail out all these banks. Why do we still have the Fed? Like, why? Why doesn't our government take more control? Why do we let the Fed control the way that they control? Why don't we, as a government, take that away from them? I don't think it's very smart, guys. Okay, so many more questions. When you read this news, you get a lot of questions, huh? Amazon stock forfeits gains. Well, that's called clickbait. Congrats on your new, what did he get? What do you get? I don't know, man. First Republic, they're in trouble. Growth in Amazon's lucrative cloud business is slowing, and investors are worried. Shares fell 4% on Friday as Amazon's cloud business slowed in April. Ooh, the cloud. I think the cloud should be free. It's just there. I don't want to pay $9.99 a month to use Apple's freaking cloud. I want to have the cloud for free. Or how about this, Apple? You let me stick a little tiny drive inside my phone for extra memory. If you want to charge me for the cloud, let me have memory on my phone. Like, man, they control us. They can't let us have anything good. They want us to pay for every little nickel and dime thing that they can get us. Blow for Biden as U.S. economy slows sharply and recession threat grows. They're jimmying these numbers, guys. We've been in a recession since last year. That's my that is my take on the government. I really think that they're lying to us. They always do. Donald Trump, if you go back when Donald Trump had the whole pandemic expo thing, he told Bob Woodward that he was lying to us. Like, I'm not telling them everything. And I think that's exactly what they're doing, Joe Biden, everybody, with the economy. Because Joe Biden came into a pandemic. He came into a losing economy. Donald Trump had closed everything down. And I'm not saying that was wrong. I'm not saying it was right. Whatever happened. It was a pandemic. But bad shit happened. And bad things happened to our country. And so one team doesn't take the blow. They don't want to take the blow for the pandemic. They make things up. And I really believe they're doctoring numbers so that we don't appear to be in a pandemic. Or maybe their numbers are based on rich people. Because the things that happen for us 98 percenters that run that live in this country and mostly run it, they're not the same as for these JP Morgan people. These people run on a whole different, even they have a different rules than us. All their rules for life are different. So I think that they're just using their rules and showing us their numbers because this isn't real life. Yeah, we had a little grow in the first quarter. We had a little grow in last quarter before that, according to them. But have you had a grow? Not many of us have had a grow. Our houses are declining in price. Everything's declining. Gas costs more. Food costs more. Nothing went down. So, I think like always, they're just tricking us. What did Shaq buy? A popular food chain. That's what he needs. Shaq, Robert De Niro, Bon Jovi, what do they all have in common? Money, and they know that people buy food. Well, what did he buy? De Niro owns Nobu and Nobu. And Bon Jovi owns. He does this nonprofit, though. You can go and get free food, for hungry people in New Jersey. That Bon Jovi restaurant. It's a good place, man. I heard about it. Let's look it up. What's it called? Bon Jovi's restaurant. It gives free food to Bon Jovi's restaurant. People should try to be more like Bon Jovi when it comes. Oh, J&J Soul Kitchen. That's what it's called. Yeah, J&J Soul Kitchen. It's a community dining with dignity. All are welcome at our table where locally sourced ingredients, dignity, and respect are always on the menu. So, I know that there's something where you can go and get free food. Do I pay for my meal? There are no prices on our menu. If you are unable to pay the suggested donation, you may still enjoy a delicious meal. We invite you to join our community to learn about resources and volunteer opportunities at the Soul Kitchen. You see that? Bon Jovi made a restaurant that has no price on the menu, just a suggested donation. And if you go and you can't afford it, you can still eat. We invite you to come enjoy a meal and learn how you can be a part of the JBJ Soul Kitchen community by volunteering. You see that? You can go volunteer here every day and just get free food. Red Bank in New Jersey. There you go. 2 locations in New Jersey. Why don't every state have something like this for their man? Good job, Bon Jovi. I heard other things about Bon Jovi that I am not, I don't agree with. But giving free food to people, I agree with that. I like that. That's some good That's some good stuff right there. Big Short. Investor Michael Burry predicted a cash crunch. A top JP Morgan banker says that painful problem is fueling a banking crisis. Americans were saving less, borrowing more, and cracking open their pandemic piggy banks. But they told us, don't worry, everybody's still rich from all those free monies we gave out. No, we're not. Barclay suggests 2 dividend stocks to buy. You guys remember Barclay? Barclay signed Barclay. Barclay is one of the original names that signed the original agreement for the stock market called the Buttonwood Agreement, guys. If you're interested in stock market history, check out the other videos in my series called Stock Market Learning. You learn about the Buttonwood Agreement, which started the stock market. Well, the stock market was already started, but it gave them legal means to do what they were doing without getting ripped off by people. This is really interesting. And the name Barclay is one of the names that originally signed the Buttonwood Agreement. He was one of the original 21 or 20 traders. So it's a big name because it's always been around. Barclays. Anyway, interesting tidbit. Now you know. So today we are going to talk about short selling. We're not going to learn everything there is to learn about short selling. We are only going to touch on it today. That is most things, guys. Do not get discouraged. We are going to learn it. You can't learn everything in one day. So today we're touching on short selling so that we understand all of the words. You have to learn trading terminology if you are going to understand trading. You're going to get in here, you're going to hear a word, you're not going to know what it is, and you're going to lose money on it. That is not good risk management. So good risk management is we know everything. So let's get to learning. Short selling, guys. Everybody hears it. When they did the GameStop thing, I heard about a bunch of short selling. I didn't really understand what it was, but now we can understand. Short selling, the definition, pros, cons, and examples. What you need to know about this investment strategy. Adam Hayes wrote it. Adam Hayes has wrote a lot of what we read. Short selling, investment activity in which the investor borrows security and sells them in the hopes of then purchasing the securities at a lower price in the future. So what he's saying, it's an investment activity. It's something you do with investment where you borrow. Securities are shares, guys. The stock. So you borrow the stock, you don't buy it, you borrow it, and you sell it in hopes that you can buy it at a lower price in the future. You get it so far? So what we're talking about, let's look at a little ticker real quick. Any ticker will do. So what they're saying is you see that it dropped down way down here, right? You see this right here, guys, how it's low, high, low. You know that this is going to drop. You see it dropping. So you say, wow, I want to buy it. I don't own it. I want to sell it right here while it's low so that I can make more money when it comes back up here high. See, it's real low, guys, down here, $16, but I know it's going to go back up. So what you do, short sell, is you borrow shares from your broker right here. At $16, you buy, let's say you buy 100 shares. $16, $160 right here. Then when it goes up, you sell those for $40, and you make all that money back on the sell. That's called a short sell. You sell something you don't really have. In online sales, e-commerce, it is called drop shipping. So guess that you're kind of drop shipping the stock. You buy it you borrow it from the broker at a certain low price, and then you sell it when it gets high at a higher price, and you make money off of a short sell. It's like a front. They fronted you the stocks. I don't know if people know about fronting things, but that's what it is. It's a borrow. It's a front. It's a temporary. You get this from their broker at a low price, and you sell it at a high price. It's almost like buying here and selling here. But first, guys, you buy. When you short sell, you sell first. Does that make sense? So we'll go back. In a regular sell, you buy low right here and you sell high, right? Buy, sell. In a short sell, you sell it right here. You don't even own it. You borrowed it. You sell it and then you buy it when it's high. The stock market is not like other things, guys. The stock market is money. So we don't have one arrow that just goes up, right? Like lots of people consider buying low, selling high. One arrow, the arrow goes up, right? Well, in the stock market, we don't just have one arrow. You can see there's this arrow could go up, this arrow could go down, right? But then something like this goes straight across. So in the money market, guys, we have 3 ways the money can go. It can go up, it can go down, and it can go across. 3 different arrows. So we have to work on a multi-arrow platform. We have to know that we can buy low and sell high, but we can also sell low and buy high. And that is another way of selling. So hopefully that makes sense. We're going to keep reading. It will make more sense as we go over this. And this will not be the only time. I tell you guys that all the time. We're going to go over all of this stuff for the next. I'm thinking that I'm going to start short. I haven't said this out loud yet because I don't know exactly how long it's going to take me to learn. But I am thinking I want to have a live market account within 3 months, guys. I'm thinking 90 days from now. I want my money available in a market account so that I can start trading, at least $1,000. And I have the 1,000 saved already, guys. If you're not saving money for the market and you want to start doing this with me, start saving right now. But I am thinking, clicked out of it. I'm thinking that within 90 days, we should be educated enough. And I know that seems like a far time away, guys, but 90 days is very short in the span of your life. If you do this for the next 90 days, you put your extra time here and we really go hard and we learn, that 90 days can change your entire existence. Not your life, not your friend's life, but your entire existence. You can go from being money insecure to money secure, and that will change your life. So 90 days may seem long. It may seem like a waste of time. But it's not, guys. School takes longer than this. If you went and got a degree, it could take you years. So we're going to really go hard for the next 90 days. And I'm thinking that that's the goal. We'll push it back further if we have to. But I'm thinking 90 days we can learn a lot of stuff. And we're going to really hit everything a multiple amount of times. So what is short selling? Short selling is an investment or trading strategy that speculates on a decline in a stock or other securities price. It's an advanced strategy that should only be undertaken by experienced traders and investors. Traders may use short selling as speculation, and investors or portfolio managers may use it as a hedge against the downside risk of a long position in the same security or a related one. Speculation carries a possibility of substantial risk, and it is an advanced trading method. Hedging is a more common transaction involving placing an offsetting position to reduce risk exposure. In short selling, a position is opened by borrowing shares of a stock or other asset that the investor believes will decrease in value. The investor then sells these borrowed shares to buyers willing to pay the market price. Before the borrowed shares must be returned, the trader is betting that the price will continue to decline and they can purchase the shares at a lower cost. The risk of loss on a short sell is theoretically unlimited since the price of any asset can climb to infinity. Short selling occurs when an investor borrows a security and sells it on the open market, planning to buy it back later for less money. Short sellers bet on and profit from a drop in a security's price. This can be contrasted with long investors who want the price to go up. Short selling has a high risk-reward ratio. It can offer big profits, but losses can mount quickly and infinitely due to call margins. With short selling, a seller opens a short position by borrowing shares, usually from a broker-dealer, hoping to buy them back for a profit if the price declines. Shares must be borrowed because you cannot sell shares that do not exist. To close a short position, a trader buys the shares back on the market, hopefully at a price less than at which they borrowed the asset, and returns them to the lender or broker. Traders must account for any interest charged by the broker or commissions charged on the trade. To open a short position, a trader must have a margin account and will usually have to pay interest on the value of the borrowed shares while the position is open. Also, the Financial Industry Regulation Authority, FINRA, which enforces the rules and regulations governing registered brokers and broker-dealer firms, They register everybody, have set minimum values for the amount that the margin account must maintain, known as the maintenance margin. If an investor's account falls below the maintenance margin, more funds are required, or the position might be sold by the broker. So you have to keep a maintenance margin, and I believe, guys, it's $25,000. 25% of the total value of securities. So if you buy $100 worth, you have to have $25 worth of money in there. Okay. So what's next? The process of locating shares that can be borrowed and returning them at the end of the trade is handled behind the scenes by a broker. Opening and closing the trade can be made through the regular trading platforms with most brokers. However, each broker will have qualifications that the trade account must meet before they allow margin trading. Why sell short? The most common reasons for engaging in short selling are speculation and hedging. A speculator is making a pure price bet that it will decline in the future. If they are wrong, they will have to buy the shares back higher at a loss. Because of the additional risks in short selling due to the use of margin, it's usually conducted over a smaller time horizon and is thus more likely to be an activity conducted for speculation. People may also short sell to hedge a long position. For instance, if you own call options, which are long positions, you may want to short sell against that position to lock in profits. Or if you want to limit downside losses without actually exiting a long stock position, you can sell short in a stock that is closely related to or highly correlated with it. Imagine a trader who believes that XYZ stock, currently trading at $50, will decline in price in the next 3 months. They borrow 100 shares and sell them to another investor. The trade is now short 100 shares since they sold something that they did not own but had to borrow. The short sell was made only possible by borrowing the shares, which may not always be available if the stock is already heavily shorted by other traders. A week later, the company whose shares were reported reports dismal financial results for the quarter, and the stock falls to $40. The trader decides to close the short position and buys 100 shares for $40 on the open market to replace the borrowed shares. The trader's profit on the short sell, excluding commissions and interest, is $1,000 because he bought 100 shares and he made $10 per share. Okay? We got it, guys. Remember that. He bought them, or he borrowed them. And he sold them. So he made he bought 100 of them for $50. That's $5,000. Then he bought 100 of them at $40. So that was $4,000. He made $1,000 profit. He paid the $5,000 back, and he kept his $1,000. Nice. So using the scenario above, now let's suppose the trader did not close out the short position at 40, but decided to leave it open to capitalize on a further price decline. However, a competitor swoops in to acquire the company with a takeover offer of $65 per share, and the stock soars. If the trader decides to close the short position at 65, the loss on the short sell would be $1,500 because it went up by $15 a share. 100 shares, $15. Here, the trader had to buy back the shares at a significantly higher price to cover their position. So he did not find somebody, or it didn't go low enough, so he had to buy high to pay back. Apart from speculation, short selling has another useful purposing, hedging, often perceived as the lower risk and more respectable avatar of shorting. The primary objective of hedging is protection, as opposed to the pure profit motivation of speculation. Hedging is undertaken to protect gains or mitigate losses in a portfolio. But since it comes at a significant cost, the vast majority of retail investors do not consider it during normal times. The costs of hedging are twofold. Here's the actual cost of putting on the hedge. There's the actual cost of putting on the hedge, such as the expenses associated with short sales or the premiums paid for protective options contracts. Also, there's the opportunity cost of capping the portfolio's upside if markets continue to move higher. As a simple example, if 50% of a portfolio that has a close correlation with the Standard & Poor's 500 index is hedged and the index moves up 15% over the next 12 months, the portfolio would only record approximately half of that gain, or 7.5%. Selling short can be costly if the seller guesses wrong about the price movement. A trader who has bought stock can only lose 100% of their outlay if the stock moves to zero. However, a trader who has shorted stock can lose much more than 100% of their original investment. The risk comes because there is no ceiling for a stock price. It can rise to infinity and beyond, to coin a phrase from comic character Buzz Lightyear. Also, while the stocks were held, the trader had to fund the margin account. Even if all goes well, traders have to figure in the cost of margin interest when calculating their profits. So the pros are possibility of higher profits, little initial capital required, leveraged investments possible, hedge against other holdings. The cons are potentially unlimited losses, margin account necessary, margin interest occurred, and short squeezes. When it comes time to close a position, a short seller might have trouble finding enough shares to buy if a lot of other traders are also shorting the stock or if the stock is thinly traded. Conversely, sellers can get caught in a short squeeze loop if the market or a particular stock starts to skyrocket. On the other hand, strategies that offer high risk also offer a high yield reward. Short selling is no exception. If the seller predicts the price moves correctly, they can make a tidy return on investment, ROI, primarily if they use margin to initiate the trade. Using margin provides leverage, which means a trader did not need to put up much of their capital as an initial investment. So some margin accounts give you 10% or 10 to 1. So if you put in $5,000, it becomes $50,000. You times it by 10. It's 10 to 1. So you see how big that difference can be. You, instead of making trades on $5,000, are making trades on $50,000 worth of capital. So you can make much bigger trades and make much bigger returns. If you're working on a little bit of money, you're going to have to make little trades, which makes little bits of money. I don't know really a lot of things to compare to. I guess if you owned a store and you were selling cheap cakes, you would be able to make cheap cake profit, right? But if your store started selling Gucci bags, now you have leverage. Your one Gucci bag can sell for as much as all your little cakes and candies sold for, right? So now you're working with more leverage. Most of the examples I can think of are negative examples, like the selling of illegal items. So I hope my cake example makes sense, but leverage means you borrow, and it's not really a borrowing money. The money is just there to leverage off of. It's not your money. It's so that you can make more capital off of them. And then, of course, they get something out of it. So it makes sense for them to loan you their money to use. But it's probably not even real money, guys. You think they really put real money in your account? It's all fox money, faux money, however you want to say it. It's fake. It's not really money. They didn't really take gold out of their account and put it in your account. It's easy. It's leveraging. So beginning investors should avoid short selling until they get more trading experience under their belts. I agree. We are learning this because we have to learn everything, guys. We have to understand this. It doesn't mean we have to use it. We have to understand leveraging, but we do not have to use it. You get leveraged and you make big mistakes, you're leveraged to owe that money. I might say that it's faux money and it's fake, but it's real for you to pay back. It might just be an IOU written on a piece of paper on their end, but for your end, it's real money and you will have to pay it back. So I don't suggest that until we are absolute pros at the market. Right now, we're going to go with our own money. We're probably never going to short sell, but we have to know about it. And I mean, probably never going to short sell with short. We're probably never going to short sell with our little $1,000 capital. Once we get that capital up and we're pros, once my capital is to $50,000, I will probably definitely short sell. So we have to go into this with our mind changing, guys. Nothing is set in stone in the market. It's cyclic and it changes and we will change with it. We'll be like the wind bending, okay? We will bend with the market and that will help us to win the market. So that being said, short selling through exchange traded funds, ETFs, is a somewhat safer strategy due to the lower risk of a short squeeze. So additional considerations. Besides the previously mentioned risk of losing money on a trade from a stock prices rising, short selling has additional risks that investors should consider. So it uses borrowed money. It's known as margin trading. When short selling, you open up a margin account, which allows you to borrow money from the brokerage firm using your investment as collateral. Just as when you go on a long on margin, it's easy for losses to get out of hand because you must meet the minimum maintenance requirement of 25%. If your account slips below this, you'll be subject to a margin call and forced to put in more cash or liquidate your position. Wrong timing. Even though a company is overvalued, it could conceivably take a while for its stock price to decline. In the meantime, you're vulnerable to interest, margin calls, and being called away. If a stock is actively shorted with a high short float and days to cover ratio, more on that below, it's also a risk of experiencing a short squeeze. A short squeeze happens when a stock begins to rise, and short sellers cover their trades by buying their short positions back. This buying can turn into a feedback loop. Demand for the shares attract more buyers, which pushes the stock higher, causing even more short sellers to buy back or cover their positions. We kind of seen that short squeeze happen with GameStop when they wanted to buy. They had short sold because they thought it was going to drop, but then the apes came in and bought it all, so they couldn't sell back. It was like a weird feedback loop. Then they were having to pay crazy prices for it. It made, what is Game Crazy at right now? Go to Yahoo Finance. GameStop. Oops, that's not GameStop. Where's GameStop? I don't know. That was weird. GameStop. 1951. So if we go back, there are 5 years. That was January 1st of 2021. They bopped all the way up to $81. That's crazy. What are they at right now? $19. They're at 81 because of a short squeeze. That's crazy. So, regulators may sometimes impose bans on short sales in a specific sector or even in the broad market to avoid panic and unwarranted selling pressure. Such actions can cause a sudden spike in stock prices, forcing the short seller to cover short positions at huge losses. History has shown that in general, stocks have an upward drift. Over the long run, most stocks appreciate in price. For that matter, even if a company barely improves over the years, inflation or the rate of price increase in the economy should drive its stock price up somewhat. This means that shorting is betting against the overall direction of the market. Unlike buying and holding stocks or investments, short selling involves significant costs in addition to the usual trading commissions that have to be paid to brokers. Some of these costs include margin interest. Margin interest can be a significant expense when trading stocks on margin. Since short sales can only be made via margin accounts, the interest payable on short trades can add up over time, especially if short positions are kept open over an extended period. Stock borrowing costs. Shares that are difficult to borrow because of high short interest, limited flow, or any other reason have hard to borrow fees. They can be quite substantial. The fee is based on an annualized rate that can range from a small fraction of a percent to more than 100% of the value of short trade and is prorated for the number of days the short trade is open. As the hard to borrow rate can fluctuate substantially from day to day and even on an intraday basis, the exact dollar amount of the fee may not be known in advance. The fee is usually addressed by the broker-dealer to the client's account either at a month end or upon closing of the short trade. And if it's quite large, can make a big dent in the profitability of a short trade or exacerbate losses on it. Dividends and other payments. The short seller is responsible for making dividend payments on the shorted stock to the entity from whom the stock has been borrowed. The short seller is on the hook for making payments on accounts of other events associated with the shorted stock, such as share splits, spin-offs, and bonus share issues, all of which are unpredictable events. So, two metrics used to track short selling activity on a stock are short interest ratio, also known as the short float, measures the ratio of shares that are currently shorted compared to the number of shares available or floating in the market. A very high SIR is associated with stocks that are falling or stocks that appear to be overhauled. The short interest to volume ratio, also known as the days to cover ratio, is the total shares held short divided by the average daily trading volume of the stock. A high value for the days to cover ratio is also a bearish indication of the stock. And bearish, guys, means bull lifts you up with his horns, bearish bears down on you. So this is a low, goes down, downward trend. Both short selling matrix help investors understand whether the overall sentiment is bullish or bearish for a stock. For example, after oil prices declined in 2014, GE energy division began to drag on the performance of the entire company. The short interest ratio jumped from less than 1% to more than 3.5% in late 2015. As short sellers began anticipating a decline in the stock, by the middle of 2016, GE share price had topped out at $33 per share and began to decline. By February 2019, GE had fallen to $10 per share, which would have resulted in a profit of $23 per share to any short sellers lucky enough to short the stock near the top in July of 2016. Timing is crucial when it comes to short selling. Stocks typically decline much faster than they advance, and a sizable gain in a stock may be wiped out in a matter of days or weeks on an earnings miss or other bearish development. The short seller thus has to time the short trade to near perfection. Entering the trade too late may result in a huge opportunity cost in terms of profit loss, since a major part of the stock's decline may have already occurred. On the other hand, entering the trade too early may make it difficult to hold on to the short position in light of the costs involved and potential losses, which would skyrocket if the stock increases rapidly. There are times when the odds of successful shorting improve, such as the following. During a bear market, the dormant trend for a stock market or sector is down during a bear market. So traders who believe that the trend is your friend have a better chance of making profitable short sell trades during an entrenched bear market than they would during a strong bull phase. Short sellers revel in environments where the market decline is swift, broad, and deep, like the global bear market of 08-09, because they stand to make wind-filled profits during such time. When stock or market fundamentals are deteriorating, and this is how, guys, we can see people be like, oh, well, the stock market's failing. But we can see that there are tricks in the stock market for these people that have a lot of money. Like in 08 and 09, when normal people on the stock market, the stocks were crashing and they were losing money. The people that are educated up here, guys, they have a good mind for this trading, for this money, and their money was already in there. They pulled out of normal trades and use this as insurance, guys. If you can short as insurance, they said they use it as a way to make sure. And during a strong bear market like 08-09, you might not be making money in actual buying securities. But if you're short selling and you're making, record windfalls, it's okay. They just change it up. That's why we have to know everything, guys, so that we don't just start making money and then the market changes and we can't make money anymore. We have to know the market so we can make money in any part of the market. So, a stock's fundamentals can deteriorate for any number of reasons: slowing revenue or profit growth, increasing challenges to the business, rising input costs that are putting pressures on margins, and so on. For the broad market, worsening fundamentals could mean a series of weaker data that indicate a possible economic slowdown, adverse geopolitical developments like a threat of war, or bearish technical signals like reaching new highs on decreasing volume, deteriorating market breadth. So all the things that can happen that make it, that make the market go down. Experienced short sellers may prefer to wait until the bearish trend is confirmed before putting on short trades, rather than doing so in anticipation of a downward move. This is because the risk that a stock or market may trend higher for weeks or months in the face of deteriorating fundamentals, as is typically the case in the final stages of a bull market. So what they're saying, you might want to wait, because when we see, look, and the might go winkety wonkety, and you think that you buy here, but then it goes back up here, and then you're facing all these fees. So you really want to wait. You might really want to wait until it goes down. And those are things that you can only get by learning, guys. So short sells may also have a higher probability of success when the bearish trend is confirmed by multiple technical indicators. These indicators could include a breakdown of a key long-term support level or a bearish moving average crossover like the death cross. We haven't seen the death cross yet. A market chart pattern in which short-term moving averages crosses below a long-term moving average indicating price weakness. Can we see one? There we go. Death cross right here. Oh, there's the moving average. And it crossed it. Okay. We know what a death cross is now. Okay. Let me just take a quick bathroom break, my friends. I'll be right back and we'll finish this up. No. Alrighty. We are back. Hair got super wild. Okay. So, like a death cross. Yep, these indicators could include a breakdown below a key long-term support level or a bearish moving average crossover, like a death cross. An example of a bearish moving average crossover occurs when a stock's 50-day moving average falls below its 200-day moving average. A moving average is merely the average of a stock's price over a set period of time. If the current price breaks the average, either up or down, it can signal a new trend in price. So that's why we look at, it doesn't show it here, guys. The moving average is not here. I don't know how to, indicators. There we go. Look at that. Moving average. We'll do the 200-day moving average. See? There we go. Look at us. We put it on there. Yay. So you see the moving average, and it says if the current price breaks the average either up or down, it can signal a new price. There you go. Look. So it broke it up here, and it was up for a minute over the average. Now it's coming down. We can, oops. When you switch between maps, it gets kind of winkety because this map is so much easier to use. Like, you use your scroll wheel, scroll in and out, and you grab it like this. But when we go on to Thinkorswim, it's a bit different. So you just have to keep that in mind. So valuations reach elevated levels amid rampant optimism. Occasionally, valuations for certain sectors or the market as a whole may reach highly elevated levels amid rampant optimism for the long-term prospects of such sectors or the broad economy. Market professionals call this phase of the investment cycle priced for perfection, since investors will invariably be disappointed at some point when their lofty expectations are not met. Rather than rushing in on the short side, experienced short sellers may wait until the market or sector rolls over and commences its downward phase. John Maynard Keynes was an influential British economist whose economic theories are still in use today. However, Keynes was quoted as saying, "The market can stay irrational longer than you can stay solvent," which is particularly apt for short selling. The optimal time for short selling is when there is a confluence of the above factors. Sometimes short selling is criticized, and short sellers are viewed as ruthless operators out to destroy companies. However, the reality is that short selling provides liquidity, meaning enough sellers and buyers to markets, and can help prevent bad stocks from rising on hype and over-optimism. Evidence of this benefit can be seen in asset bubbles that disrupt the market. Assets that lead to bubbles, such as the mortgage-backed security market before the 2008 financial crisis, are frequently difficult or nearly impossible to short. Short selling activity is a legitimate source of information about market sentiment and demand for a stock. Without this information, investors may be caught off guard by negative fundamental trends or surprising news. Unfortunately, short selling gets a bad name due to the practices employed by unethical speculators. These unscrupulous types have used short selling strategies and derivatives to artificially deflate prices and conduct bear raids on vulnerable stocks. Most forms of market manipulation like this are illegal in the U.S., but still happen periodically. Important. Put options provide a great alternative to short selling by enabling you to profit from a drop in a stock's price without the need for margin or leverage. If you're new to options trading, Investopedia's Options for Beginners course provides a comprehensive introduction to the world of options. It's 5 hours of on-demand video, exercises, and interactive content offer real strategies to increase consistency of returns and improve the odds in the investor's favor. So guys, we are definitely, once we get our stocks buying, selling under control, we are going to change. We are going to try learning. This is the whole program. $199, you get lifetime access, and it does all of this, understanding options, puts and calls, for trades, setups. So we are going to go through all this, but not through this course. So stay tuned. Unexpected news events can initiate a short squeeze, which may force short sellers to buy at any price to cover their margin requirements. For example, in October of '08, Volkswagen briefly became the most valuable publicly traded company in the world during an epic short squeeze. In '08, investors knew that Porsche was trying to build a position in Volkswagen and gain majority control. Short sellers expected that once Porsche had achieved control over the company, the stock would likely fall in value. So they heavily shorted the stock. However, in a surprise announcement, Porsche revealed that they had secretly acquired more than 70% of the company using derivatives, which triggered a massive feedback loop of short sellers buying shares to close their positions. And a derivative is a financial contract whose value is dependent on underlying asset, group of assets, or a benchmark. So, gosh, come on. Short sellers were at a disadvantage because 20% of Volkswagen was owned by a government entity that wasn't interested in selling, and Porsche controlled another 70%. So there were very few shares available on the market, float to buy back. Essentially, both the short interest and days to cover ratio had exploded higher overnight, which caused the stock to jump from the low 200s to more than $1,000. A characteristic of a short squeeze is that they tend to fade quickly and within several months. Volkswagen stocks had declined back to its normal range. A short position is one that bets against the market, profiting when prices decline. To sell short is to take such a bet. This is opposed to a long position, which involves buying an asset in hopes that the price will rise. So, short is a bet, it is a short-term profit, quickly, long-term, you buy it, hope it'll rise. Got it, guys. Why do short sellers have to borrow shares? You cannot sell something that doesn't exist. Since a company has a limited number of shares outstanding, a short seller must first locate some of those shares to sell them. The short seller, therefore, borrows those shares from an existing long and pays interest to the lender. This process is often facilitated behind the scenes by one's broker. If there are not many shares available for shorting, then the interest costs to sell short will be higher. While some people think it's unethical to bet against the market, most economists and financial professionals agree that short sellers provide liquidity and price discovery to a market, making it more efficient. Many brokers allow short selling in individual accounts, but you first must apply for a margin account. Because short sales are sold on margin, relatively small losses can lead to even larger margin calls. If a margin call cannot be met, the holder of the short position must buy back their shares at an even higher price. This works to bid the price of the stock even higher. The bottom line is, short selling allows investors and traders to make money from a down market. Those with a bearish view can borrow shares on margin and sell them in the market, hoping to repurchase them at some point in the future at a lower price. While some have criticized short selling as a bet against the market, many economists believe that the ability to short sell makes markets more efficient and can actually be a stabilizing force. Technical traders and analysis, you guys have to remember when this doesn't make sense to you, like because we don't have money, like it doesn't make sense to bet against something you made to make money, but it does if you are in control of it all, if that makes sense. When they signed the Buttonwood Agreement so that people couldn't take advantage of them, they were putting into action all of these forces. Of course, something they do creates a more efficient and stable market. They created it that way. They created calls and puts and short selling so that they can continue to make money on the market that they created. So if something doesn't make sense to you, perhaps it just doesn't make sense to you from the angle that you're looking at it at. Instead, try to not look at it from Squealer D's perspective that grew up, and never invested in the stock market and was kind of poor. Look at it from the angle of the Barclays, who signed the original Buttonwood Agreement so that people could not steal their money, and they formed and made these rules. These are their rules, guys. They are not just letting people. They made the stock market so that they could control it. It's not just some willy-nilly Wild West where you're stealing people's money. This is a stabilizing force, an efficient force, because they made this. So if something doesn't make sense to you, look at it from their point of view. Technical traders and analysts often look at a stock's short interest and other ratios involving short positions to inform trading ideas. However, large short positions can become squeezed due to margin calls. The buying that is required to close short positions can force higher prices higher and accelerate a rally, making losses to shorts even more severe. That's selling you something. That's it. So now we know about selling short selling. That was great. All right. Well, Money Dog, our official money talk. She's our mascot, guys. She's running amok. Come here, Butters. Come here. Come here. Come here. You want a treat? Come on. You want a treat? Come on. Come on. Give her a treat from underneath. That's what she wants. Butters, you want a treat? I don't know. Huh? Yeah. Butters, you want a treat? Butters, you want a treat? Sit down. Alrighty, guys. So she is ready for her treat. She does not want to come say hi. So I am just going to leave it at that today, guys. We are not going to practice anything on Think or Swim because I don't think we should practice shorts. Like I said, that's for a margin account, which we're not going to have. So tomorrow or Monday, we will be back practicing our sells and buys, guys. We have a lot to practice, different options of purchasing and selling on the market. So join us back on Monday, same time, same place. Be there or be square, neighbors, and we will do much more, my friends. So until next time, have a great day. Bye, neighbors.